Have joined in. So welcome again, and thank you very much for joining us in our new Zoom format. You have Anna Derewenda and Farhad Aghdami here, and we're going to give an update on tax and wealth planning. So to jump right in, I'm going to be talking about tax planning for individuals that are dealing with losses in their pass-through entities. So it's definitely something that's on the minds of a lot of our taxpayers and business owners. You know, with the ongoing COVID saga, that's something they're definitely dealing with, and they're trying to figure out how they can maximize cash flow. So Congress had anticipated this and put some provisions in the CARES Act that made it more likely that they would be able to use those losses to get refunds and to try to use it as another source of cash. So we'll go through a little bit of just a brief overview of the CARES Act, just to kind of set the stage, and then how to deal with those rules at the same time as dealing with some of the historic rules, because there are a lot of hoops that taxpayers have to jump through in order to be able to access those losses. And then we'll bring it all together with a couple of examples and just show some of the things that we've seen taxpayers dealing with and trying to work through in order to be able to access those losses. And if we have time, then we'll also talk about some of the procedural aspects of actually filing the returns and getting those losses. So to go through the CARES Act made quite a few changes to individuals and businesses and how they can access their losses. A lot of these were in reaction to the 2017 TCJA, which had put in a lot of provisions either restricting the use of losses or changing some of those rules. And it also, the CARES Act also changed some of the provisions, like the deductions for business interest, access to bonus depreciation for qualified improvement property that affect just how much of an NOL a taxpayer has. So on the net operating losses, the TCJA had changed the rules. Prior to 2017. Taxpayers could carry back losses 2 years and then carry them forward 20 years. The TCA changed that so that taxpayers could no longer carry back losses and could carry them forward indefinitely. It also subjected taxpayers to a cap limiting their ability to use those losses to 80% of their adjusted taxable income. So the CARES Act reversed some of those or loosened them up a little bit just temporarily. So under the CARES Act for 18, 19, and 20, it removes the 80% limitation, and it also allows for losses arising in those years it's the default setting for those losses have to be carried back 5 years. So they're carried back to the earliest applicable year. So for example, if you have losses arising in 2020, those losses are automatically need to be carried back to 2015. But there is an election that taxpayers can make to elect out of that carryback and only carry those losses forward. And the CARES Act retained the ability for losses incurred in years beginning in 18 and onwards to be able to carry those forward indefinitely. So this provision applies to not only corporations, but also estates, trusts, and individuals. But individuals had one more hoop to jump through in order to be able to use those losses that was put in place by the TCJA. And that was the excess business loss limitation under 461L. So this was a new limitation that the TCJA added, and it basically provided that taxpayers are permitted deductions that are attributable to a trade or business only up to the amount of income or gain for that year, the business income or gain for that year, and they can't take excess business losses against other types of income like investment income and wage income. So except to the extent of, I think it was 250 indexed for inflation, which was provided by Rev. Proc. 1944 prior to the CARES Act. So the CARES Act basically delayed the application of this until years beginning after December 31st, 2020. So that means for losses incurred in 18, 19, and 20, taxpayers are no longer subject to that limitation. And the CARES Act also made some technical corrections and clarifications. So those are sort of the two major changes to how losses are used that we saw in the CARES Act. But the CARES Act also did change how losses might be calculated, or what goes into your loss amount. So it increased the amount of business interest deductions, so from the 30 to the 50% of adjusted taxable income, and there are special rules for partnerships. And it should also mention that the IRS just, I think at the end of last week, issued a whole bouquet of rules around this provision. We have final regulations, we have proposed regulations, we have an FAQ, we have a notice, and there's a lot in there that will probably be the subject of either an alert or another tax forum. So we're not going to get into details in here, but they're definitely worth looking at. Even just look at the highlights, because they do go through and have some good provisions in there for partnerships, for S corps, for electing real trader businesses. There's a good bit in there. The other change that the CARES Act did was that they fixed the retail glitch. So it allows the qualified improvement property to now be correctly eligible for bonus depreciation. One issue that came up out of the CARES Act that folks are waiting on and sort of struggling with at the moment is the denial of deductions for expenses that are paid by PPP loans that end up being forgiven. So while the CARES Act specifically provided that if you have a PPP loan that is forgiven, the amount of that forgiveness, which we typically think of as cancellation of debt income, it will be excluded from gross income. So the question then was, well, if I am excluding the loan amount from gross income and I'm also getting the deduction, is that a double dip? And the IRS basically said yes, and there's statutory authority for that Section 265 basically disallows deductions that would otherwise be allowable, but that are allocable to classes of tax-exempt income. And so under the statute, the IRS says, you know what, we don't have authority to be able to give that deduction. And if Congress wants a fix, then they have to do the fix. So it appears that a fix does have bipartisan support. It was included in the HEROES Act, but it seems like it's still sort of up for debate. So we've got fingers crossed, but we need to wait until we actually see that enacted for relief on that point. So those are some of the key provisions that went through the CARES Act. But before we even get to those, taxpayers have to go through some of the historic rules to be able to access those deductions and losses. So historically, they've had to go through business limitations, they've had to go through the at-risk limitation, through the passive activity limitation, and after the TCJA, the excess business loss limitation. So a whole lot of steps before you can even get to a deduction and being able to use those losses. I'm not going to talk about the at-risk and passive activity limitations because those are definitely their own subjects for a whole nother day's worth of tax forum, but I will talk about the business limitation. So for individuals that own their businesses through flow-through entities, either partnerships or S corporations, partnerships or S corporations are similar but different. But basically, so for a partnership, you have no losses allowed in excess of the partner's basis in that partnership. And what goes into the partner's basis? It's typically contributions, allocation of income, and their share of the partnership's liabilities. And similarly, for S corporations, a shareholder gets their basis from contributions they make to the S corporation, and certainly shares that they purchase, which is true for both partnerships and S corporations, their allocation of income. They do not get a share of the S corporation's liabilities, but they do get debt basis. So they can take losses to the extent of both their stock basis and their shareholder debts to the S corporation, so loans that shareholder has made to the S corporation. And for both, excess losses can be carried forward. So what does that mean, and what does that look like? So for S corporations and for partnerships, for S corporations, the Treasury regs specifically say that disallowed losses will retain their character, and they're treated as incurred by the corporation in that succeeding year where they're freed up. And that's very important, as we'll see in an example coming up. Now, for partnerships, it's sort of the same deal. They appear to retain their character in later years and should be treated as incurred in the following year as well. So how can we bring all of this together? That's a whole lot of information. We've got the CARES Act and these loosening restrictions on losses, but we have to get through some of these historic limitations. So let's look at a couple of examples. So let's say we have a taxpayer with an S corporation, and in 2013, that S corporation had capital gains. And then in 14 through 17, they had ordinary income. Something happened in 2018, they hit a rough patch and they had a whole lot of losses that the individual taxpayer couldn't take because they were limited by the new excess business limitation. And then in 2019, they had ordinary income. So prior to the CARES Act, this taxpayer may have expected that to the extent that these losses were limited, they could be carried forward and taken against the 2019 ordinary income. But now with the CARES Act eliminating this limitation, the default rule is that where an NOL is created here in 2018, that has to be taken back to 2013 and used against these capital gains. So there may be a rate difference here for the taxpayer who may actually have more income, because here it's reducing income that was taxed at the 20% rate versus the expected ordinary income that would be taxed at a 37% rate. So one thing that the taxpayer may consider here is whether they want to go ahead and make the election to forego the 5-year carryback. Now compare this situation with a situation where same setup, and that the taxpayer owns the S corporation, and that in 2018 they had business losses that were limited by the excess business limitation, but they also had capital gains in that year. And then in 2019 they had ordinary income. So it's the same beginning analysis. This taxpayer, prior to the CARES Act, to the extent that these losses were left over, would expect to use them in 2019 against their ordinary income. But after the CARES Act, again, this limitation is eliminated temporarily. And the taxpayer would be required to use these losses to offset the capital gains that they have in 2018. And they may not have any losses then remaining to carry forward to offset their ordinary income. So again, here there's a rate difference. 20% reducing the capital gains that are taxed at 20% versus reducing the ordinary income that's taxed at 37%. The difference between this example and the prior example is that we're not dealing with NOLs here. It's just what happens in a single year. So we're not dealing with any carryovers. And the excess business limitation elimination is not elective. So in this situation, the tax liability of the taxpayer may actually increase. So it's definitely worth, between these two examples, going through and modeling out what's happening, especially when you do layer on the complexities of the at-risk rules and the passive activity rules, modeling out not only what's going to happen in a single year, but also across all years, and what a taxpayer's situation may look like. So the next example is slightly different. We have, again, a taxpayer and their S corporation. And in 2015, they have capital gains and ordinary income. Maybe they sold a part of the business or a division. And so in 2016 through 17, there's not much left, or the businesses that are remaining have losses. And those losses are actually limited by the taxpayer's basis in the S corporation. So those suspended losses have been carried forward to 2020. They went through 18 and 19 and 20. So the question now is, can the taxpayer access these losses in 2020? Because presumably if they can access the losses in 2020, and under the S Corp rules, they're treated as being incurred in 2020, they're now subject to our 2020 rules, which include the ability to carry back those NOLs for the 5 years. So they could carry them back to 2015 and offset some of the income that was incurred then. So the question is, how do we access those losses? And typically we think of, how can we increase the basis in the S corporation? So there's a whole lot of different ways to do this, and we've just included a few here, although there's a whole lot of different variations on this. So for S corporations, you can either look to increasing the stock basis or the debt basis. So with stock basis, you're looking at contributing cash or property, or purchasing additional shares, maybe deferring distributions. And on the debt basis, you're looking at either personally lending money to the corporation, or maybe paying all or a part of some of the S Corp's debt that's guaranteed by that shareholder. So these rules, and again, there are sort of different, a whole bunch of different variations on this, as far as where you're getting the money from, and the interactions between the taxpayer and the S corporation. And these issues have been around for a long time. You know, we certainly have new considerations now because of the CARES Act, but taxpayers have historically tried to increase their basis in their flow-through entities. That's been an issue for a long time. So there's a whole lot of guidance and case law around taxpayers trying to do this. You know, if you think of the simplest scenario where a taxpayer does actually have cash, maybe they have one business that is performing well and another business that is not performing so well, but they're actually able to move the cash over because they have those funds. Or it's a high net wealth individual that does have cash and wants access to those losses. Even in that scenario, there are some considerations that you have to go through. That's sort of like the most basic scenario that you can have. But there's evidence that the IRS and Treasury might still look to make sure it's not a sham transaction. You know, is this all done on the last day of the year and then reversed out the following year? Do you have a business purpose, maybe besides trying to access those losses, for making that contribution? And sort of once you get past the technical, there are also some practical considerations. Maybe that's not the only shareholder in the S corporation. So are all of the shareholders willing and available to put additional cash into the S corp? Especially right now, one risk may be that they don't want to put additional funds into an S corp. They don't know if they're actually going to be able to get those back. You know, if it's a business that's not doing well, you know, there may be a question of which way that business is going to go. A shareholder if you have multiple shareholders, maybe one of them will decide that they don't want to make a pro rata contribution, And so maybe the other shareholder will actually be able to just put a loan in instead of doing a contribution. But then they do have to understand that that loan is not going to increase their share of those losses. So there are definitely some practical considerations. And on the next slide, we've gone through a few different variations of this because, as you might expect, shareholders that are trying to access those losses may not be in a position where they actually have cash to give to the entity to increase their basis, or they simply may not want to do it. So they want to minimize their economic outlay. And that term, economic outlay, is really exactly what the IRS does look to. So, and especially in situations where you're getting money from an affiliated entity in the group, or maybe from a willing third party, like in this example in the Stewart Pike case where they used a promoter. So basically there was a circular flow of cash that the tax court really did not like. So you really need to have, in pretty much sort of all of these situations, a true economic outlay, you know, and looking to things like, do you have a business purpose? Is there a good argument that it's not a sham transaction? So there are different variations the slide goes through. You know, if you're, instead of the shareholder having the funds, maybe you are borrowing from a third party and then contributing the money to the S corporation. Or maybe you'd rather borrow from the third party and loan the money to the S corporation. So this was specifically approved by, seems to be approved by regulations that were issued in 2014, sort of this back-to-back loan concept, as long as the loan is bona fide. So, but there is still the question of the prior case law, and the Morello case that we cite below down here sort of makes the argument that, you know, whether this test versus the economic outlay test, you know, may not be so different. So all that case law is still very important. And so these are just some additional examples. So we've been talking about S corporations, but the same is generally true of partnerships in terms of how do you increase your basis in a partnership. Additional contributions, deferring distributions, changing the allocations of either the income or the losses or the liabilities. And the same questions have arisen in the partnership context too, as far as, do you have a separate business purpose for these, or, you know, would it be considered a sham transaction? So these basic, we have these questions of, can the shareholders and partners access these losses? But things to, you know, we've seen some additional traps and additional considerations. And I'll look at the bottom one here first. So taxpayers do have to realize that to the extent that they are using their basis and decreasing their basis now to access those losses, that basis is decreased. So there may be some recapture event later on. For example, if a partnership pays off liabilities, it's treated as a distribution. Is that now in excess of the basis of the partner and now taxable? If you're looking at selling an entity, do you now have a lower basis that's going to increase your gain on the sale of that stock or interest? And a couple of things to keep in mind that we have seen folks be surprised about is that if you do have suspended losses and you're not able to access them, if you sell those interests, you will lose those losses. They do not transfer over to the transferee. So if you're looking at a sale, question whether you can be looking at the sale of the interests or rather a sale of the assets, which might create gain within the company and therefore serve to increase basis and help utilize those suspended losses. Another thing that folks have been surprised about is so many of our taxpayers are going to be looking at 2020 losses. And while there are some taxpayer favorable guidance that has come out for accessing 18 and 19 losses as soon as possible, for 2020 losses, whether you do it through an amended return or through sort of the fast track application, you have to wait until the end of the year. So for taxpayers that are trying to get cash right now, if they have losses for 2020, unfortunately, there is going to be a time period that they do have to wait on in order to be able to get those refunds. Another point for consideration may be what is included in your losses. Can you use installment sale to maybe defer income into next year, or accounting method changes, so that you're really maximizing the access to the losses in 2020 or 2018 or 2019 before they go back to some of the more restricted rules in 2021. And always we have passive activity issues and state tax issues. So Virginia right now, I don't think we've seen, and we might not expect for a while to see whether they will conform to the federal rules. They have not. I think when we saw NOL changes in 08 and 09, so having the state tax overlay on that and keeping those in mind that may be different from federal is something to keep in mind. So I'm going to flip it over to Farhad in a second, but in terms of filing for the refunds, we have some additional slides. You can either look at amended returns or look to the quick refund procedure, and there's sort of pros and cons for both of them. So there may be some, especially if you're looking at large refunds, there may be some considerations there, you know, looking at which option that you choose. And then the rest of the slides go through just some IRS guidance that's tried to make it easier for taxpayers to be able to access those claims for partnerships and for folks accessing 2018 claims. And then this last slide is just a point to say, you know, these are the rules in the CARES Act. But some of them are still under consideration. And given the fact that there has been a fair amount of public outcry in terms of what breaks and benefits that Congress is giving to businesses, you know, there has been some pushback. The HEROES Act looks to push back some of the benefits for, it basically looks to reinstall the excess business loss limitation and limit the availability of carrybacks. So, you know, while taxpayers are planning and trying to figure out how they're going to access losses and what they're going to do need to keep an eye on the legislature to see if those rules are going to change and if they are able to change them retroactively. So with that, thank you all very much, and I will now flip it over to Farhad.
Great, thanks, Anna, and good afternoon, everybody. I'm going to spend the next half an hour just going through some recent developments in the wealth transfer tax planning arena, both regulations and some guidance, but also some case law, and then we'll finish up with some discussion on maybe some planning opportunities, things that might make sense, particularly right now and as we head towards the end of the year. So, Anna, if you can maybe go to the next slide. Let's see, and I guess the next one there. So the first thing is under the CARES Act, there are a couple provisions that I think are interesting for individual taxpayers. There's one of the provisions included the waiver of the 10% penalty tax on early distributions from IRAs. And the idea was to make relief available or allow folks to access funds in their IRAs if they are, you know, encountering something related to the coronavirus, if they're economically harmed, and they're allowed to withdraw up to $100,000 in distributions on a penalty-free basis. And so they enacted this legislation, and you'll see if we go to the next slide that a couple weeks ago the IRS issued, Anna, can we go to the next slide? Okay, great. The IRS issued Notice 2020-50, which includes guidance for around this, and gives a little bit, adds a little bit meat to the bone in terms of who is eligible, what is a qualified individual that can take advantage of this. Also describes what are the amounts that are available for these types of distributions, maximum amounts, tax reporting, those kinds of things. So just helpful guidance out there if you've got somebody who is seeking access to these funds on this basis. If we go to the next slide, you'll see that as part of the CARES Act, they said that taxpayers do not have to take their required minimum distributions in 2020. And that's great. And the idea really was the financial markets went down, certainly in March, and they didn't want taxpayers to be forced to pull money out of their IRAs at a low value. And I guess that was somewhat short-lived because the markets have rebounded a decent bit over the last few months. But really, this allows taxpayers to avoid pulling money out. Now, the question is, and this is similar to something that they did in 2009, the question is, well, what happens if you pulled money out? Is there a way to put it back in? And if we go to the next slide, the service said, well, the withdrawal of itself, because required minimum distributions aren't required in 2020, the withdrawal is a distribution that could be rolled back into the IRA within 60 days. And I think that's great for anybody who's taking something out recently. But what about the person who, religiously takes their minimum required distribution on January 3rd every year? The CARES Act was passed after the 60-day period. Is there any relief for those folks? And the service issued notice 2020-51 that gives taxpayers until August 31st of this year to restore required minimum distributions, so they can essentially just put back into their IRAs RMDs that they've taken this year, and they don't have to take that amount into income. So I think that's obviously good planning and something that folks should be mindful of. It's August 5th, so there's 26 days left to do this, and I think most people are kind of on top of it, but I do think it's an important item to consider. If we can go to the next slide. The service also issued some regulations dealing with excess deductions. So you may recall that in part of the 2017 Tax Act, they eliminated some of the deductions, or at least temporarily, the miscellaneous business deduction, itemized deduction for business expenses, subject to the 2% floor. And the question is well, what happens if you have these expenses, in a trust, and the trust terminates? How are these expenses handled upon termination under Section 67G and 642H, which is the trust termination provision? And really, the regulations make sense. They basically say those deductions in the hands of the trust flow out to the beneficiaries of the trust as the same character. So if it was an adjustment to gross income in the hands of the trust, it will be the same in the hands of the beneficiary upon termination. By the same token, if it's a miscellaneous itemized deduction, it will be in the hands of the trust. It will be have that same character in the hands of the beneficiary, and to that point, it won't be deductible at least through the end of 2025. So just guidance that came out recently that we thought we'd share. Now, if we go to the next slide, there's some case law that has come out, and the first one is involving the estate of Moore. This is what I would call a bad facts family limited partnership case, common fact scenario. Client goes to the doctor, is given a poor diagnosis of some health condition and does not have a long time to live. And so the second stop is the estate planning attorney to say, what can we do? And this has all of the bad facts. I think the individual transferred assets into a family limited partnership. The idea is they wanted to transfer the family farm into this partnership. The stated purpose was to teach family members about management of the farm and to allow them to learn from the patriarch about how you manage the farm. The farm was sold a month later. So the whole idea of perhaps teaching the family may not have been a purpose that the tax court accorded a great deal of weight. And there was all sorts of sort of mismanagement in terms of they were commingling funds. The client continued to reside in the property. They're paying personal expenses out of the family limited partnership. The attorney who sort of designed all this charged a design fee. He's paid $320,000 for essentially forming a family limited partnership and selling these interests, transferring these interests to a trust. And the tax court made note of that and just felt like this was a little too cute. And so they said that 2036 applied. They said that there was no real valid business purpose. You know, the decedent really retained the use and enjoyment of the property and the income from the property until his death. And so it was a fairly easy case for them to disallow. If we go to the next slide, there's the Bowles case. And this is kind of, and I see this in my practice a fair amount. A parent will make loans to their child to maybe help them start a business, and they'll continue to accrue interest on those loans. And you know, over time there may be some repayment, but certainly not repayment in full. And the question is, at what point do these loans become actually a gift? And in the Bowles case, this is essentially what happened. Mrs. Bowles lent money to her son, who was a very bright architect, but was not able to be very successful financially in his business. And at some point, really the thought was, well, these loans really aren't loans, that they're really gifts. And so they essentially, the tax court said, after about 5 years of really not seeing any repayment, and didn't see any likelihood of her son being able to repay her back, they really went through and recharacterized these loans as gifts, and which ultimately increased her you know, her taxable gifts at the time they were made. So something to be, you know, think about, because I do think that is a common situation that we encounter in all of our practices. The next case is the Nelson case, and this is, you know, sort of the headline is the defined value clause doesn't work, but I think there's actually a lot of good stuff in this case. So what essentially happened was the taxpayer, Mrs. Nelson, decided to, she gifted basically about $2 million worth of a limited partnership interest to a trust, and this was done, I think, around December 31st. And then on January 2nd of the following year, 2009, she sold, I think, $22 million worth of limited partnership interests to the trust using a similar transfer clause. And the transfer clause said, Mrs. Nelson desires to make a gift to her trust and transfer limited partnership interest having a fair market value of $2,096,000 as of December 31st, as determined by a qualified appraiser within 90 days of the effective date of the assignment. And this is sort of the, you know, there's a, you know, for, I can't remember the phrase, sort of the, you know, the universe for a want of a nail or something. If they instead in saying she's transferring interest having a fair market value of $2,096,000, not as determined by a qualified appraiser, but as finally determined for federal gift tax purposes, she would have been okay. Because that's really, at the end of the day, you can find an appraiser who will say these are the interests that are worth $2,096,000, but if the IRS doesn't agree, your defined value clause really doesn't work, because they're going to come in and say, well, this is what you've transferred. And if your appraiser disagrees, if the court ultimately says that, that the value that your appraiser came up with is different, then you're going to be paying gift tax. And that's effectively what happened, is they reduced the size of the discount. And so even though the appraiser determined this, it really needs to be finally determined for federal gift tax purposes. So what I would say is this tells us, and actually, if you think about the McCord case, actually didn't use the word "is finally determined" for federal gift tax purposes also. So I think the good news is that in the case law involving defined value clauses, Wandry, McCord, Petter, Christensen, King, very often those cases are looking at and using the language "as finally determined" for federal gift tax purposes. So this is a lesson in what works and what doesn't work. It didn't work here, but the good news is, there are a number of things that happened here that were positive. If we could go to the next slide, Anna, what we had is a situation where I think the court was open to the use of a defined value clause. They just said you didn't include the magic language. The other thing is just sort of the timing. They transferred the assets in 1 year, sold them, 3 or 4 days later. The court really didn't have any issue with that. Very often, when we're doing a sale to a grantor trust, we will gift seed money of often cash as sort of the down payment to create some equity in the trust, and then follow it on with a sale of the interest. Here, the seed money was actually 10% of the actual limited partnership interests. So there wasn't cash, and the court really didn't have any issue there. So there's some interesting things about the case. There's some positives here. But as we move towards, and I'll talk about this in a little bit, as we move towards year end, I think we're going to be looking at gifting perhaps, maybe not at the pace we did in 2012, but certainly thinking about what may happen, particularly in November. And so using defined value clauses like this can be helpful as a way to manage valuation risk. Let's go to the next slide. I guess maybe go to the next one. So kind of to that point, as we are heading into November, everyone is all of our clients are very focused on what may happen in the election, both in the White House and particularly in the Senate. The world has changed a lot in the last 6 months. It's just kind of staggering if you stop and reflect everything that has happened. And a large portion of the population has been displaced. A lot of people are frustrated with the response to the pandemic. People are frustrated on both sides, whether people are either wearing or not wearing masks. But I think a lot of our clients are frankly just stepping back and saying, look, the federal government has injected $3+ trillion into the economy, and at some point taxes may go up because we got to pay for this at some point. And they're also concerned about what may happen. The tax laws right now are sort of priced to perfection. They've never been this good, except for maybe 2010 when there was no estate tax. But with exemptions this large and tax rates historically as low, 35% was the lowest, but when I started practicing it was 55%, so 40% is not bad. Clients are concerned about what may happen, so they're thinking about maybe doing some planning ahead of that, especially if things could change in 2021. If we go to the next slide, the Biden estate or tax proposal, at least when it speaks to estate tax, there's not a lot of detail. The proposal is really to eliminate the step up in basis at death, and that could be a couple things. That could be that death is a realization event, and so in Canada, essentially death is treated as a capital gains event. You're treated as having sold all your assets, and a capital gains tax is recognized at death. There's some exemptions and similar planning to what we do today here in the US. But the idea is, essentially you would just report all that gain on the decedent's final income tax return, and there's some simplification there. The other is that we retain the estate tax. So we keep the current estate tax as we have it, but we just don't have Section 1014 that steps up basis at death. To a certain extent, obviously that's a bad thing because just for record keeping, but also for clients that have highly depreciated property, real estate, that's a bad thing because they don't get that step up in basis. But to a certain extent, it it's somewhat liberating because we have clients who, are holding low basis assets until death, with the thought that they would get a step up in basis at death and maybe not gifting. And it's somewhat liberating in the sense that now you're like, well, I don't have to wait for, death to occur. Let's just go on and move these assets because there's no real benefit to be obtained. So it's kind of an interesting dynamic. And hopefully as the campaigns progress, we may see some additional detail in terms of what is really intended by eliminating step-up basis at death. Let's go to the next slide. So really, I think in terms of planning through the end of the year, we're looking at taking advantage of low interest rates, and we'll talk about that in a second. We're also looking at lower valuations. I was on a call this morning where it's our firm's retirement plan committee call, and somebody said the S&P 500, has come back, but of the 500 stocks in the S&P 500, I think 5 of those are up 23%, whereas the other 495 within that basket are year-to-date down about 8%. So it's outsized performance by a number of stocks, that Amazon, Google, Apple, that are really driving that. And so while certain asset classes have rebounded nicely, there's still a number of assets that are still depressed in value. And so there may be some opportunity there to do some transfers. And then we're also looking at doing some year-end gifting, as I alluded to, creating trust and maybe taking advantage and using the current large exemption. So let's go to the next slide, talk a little bit about interest rates. So interest rates are as low as they've ever been. The 75-20 rate is the absolute lowest, 0.4%. It's the lowest historic ever. The short-term rate is actually not the historic, so it didn't get the green bar there. It was actually 1 basis point lower in October of 2011 of 16 basis points, but the midterm and long-term rates are at their absolute lowest ever. So, the opportunity now is to take advantage of planning where interest rates are sensitive and can benefit from the low rates. If you go to the next slide, a couple things. First, we have clients who have either made loans to other family members or have sold assets to trusts for the benefit of family members. And so we've been going through and we're refinancing these loans. And these, even if you, consider the prior slide, interest rates had been, 3 or 4 times higher just 6-8 months ago. And so even transaction sales that we did in December, we're going back and refinancing because you're cutting your interest by so much. Obviously, you need to think about the income tax consequences on that refinancing. Make sure there's the ability to refinance. Typically, a prepayment clause will suffice. Also, think about fiduciary issues. If someone is accepting a lower interest rate or maybe a longer term, are there fiduciary issues there? And obviously, if there is, very often we're selling into grantor trusts, so we're less concerned about the income tax consequences. But if it was a taxable sale, especially on a sale, then is that modification a disposition of the installment obligation? So obviously you want to be careful there, but it is something I think it's certainly worth considering. If we go to the next slide, I think the other thing is from valuation perspective, the appraisers that we talk to are telling us that the valuation discounts that are applied to closely held business interests have gone up. And obviously, the risk of receiving free cash flow, what an investor would expect, has gone up substantially. Getting access to people, business operations have been disrupted, supply chains have been disrupted. I can't get any, Clorox wipes or toilet paper, so we know getting access to some things is challenging. But as a consequence, the discounts for lack of marketability, should go up to reflect increased volatility, just the practical difficulty in engaging in M&A transactions when buyers and sellers can't meet or don't want to meet. And there may be some reluctance to invest in illiquid securities. I think going into downturns, people like to load up on cash, and loading up on illiquids may not be as appealing. And banks are also looking at their balance sheets, and they're increasing the stringency on underwriting, and so that may create some challenges. And so we actually think that now is a good time for all these bad reasons or bad news. We think is a good time because valuations and certainly the discounts should be going up. If we go to the next slide, the planning techniques that we like, that these are kind of what we do all day, every day, but they are extra good right now because you're sort of taking lower priced assets and marrying them with lower interest rates, and so it produces, the results are just that much better. The things that we do, grats, sales to grantor trusts, family loans, charitable e-trusts, and maybe talk about Roth IRA conversion. So just to go through these slides quickly, the next slide I think talks about a grat. Client puts assets into the trust, retains the right to receive the assets they contributed back over typically a period of 2 years. The Section 7520 rate is 4 basis points. So if you can earn 4 basis points on this investment, anything above that, you're going to transfer estate tax-free, gift tax-free to your family. So the hurdle on the return of the underlying asset is very, very low. So it's a very compelling time to be thinking. And the nice thing is it's a heads I win and tails I don't lose proposition, because if the asset doesn't appreciate, you just get the shares that you contributed back. And I think this is something where, there's certain sectors, asset classes that are depressed that we think, will rebound back certainly in the next year or two. Hopefully we get a vaccine soon. I think this is a technique that I think works really, really well. If we go to the next slide, the next one is the sale to the grantor trust. And this is one I think where a closely held business interest, getting a good valuation, both to reflect maybe, just maybe not as good operating results, but also larger valuation discounts. Now is a good time. So the client would create the trust, sell the asset to the trust. We can structure a note where it's a 9-year note, a midterm rate note at 41 basis points, lowest rate ever. And the idea is the cash flow from the business will be used to service the note payments. And this is just a great way to get the asset out of the client's estate. If we go to the next slide, the charitable lead trust, this is something, there's no shortage of need, particularly now. And, we're really fortunate so many clients have been so generous and stepping up to help out in a lot of different ways. The charitable lead trust is a great way to get a very large upfront deduction, create a grantor charitable lead trust. In this example, it's funded with $1 million. It has a set payment of $42,000 a year for the next 25 years. So effectively over 25 years, $1,053,000 will go to charity, but any appreciation of those assets really above those annuity payments will shift out to the client's family estate tax free. And so in this example, it's almost $3.7 million, over $3.7 million that's being transferred at the end of that 25-year term. And so this is a nice way to both do good in the near term by benefiting charity and also getting an upfront charitable deduction, and then also on the back end having assets go to the client's family. And this is something I like, especially when we have a client who wants to have a very large income tax deduction in a year where they may have a large income event. And in often cases, the client may marry this with something like a Roth IRA conversion. And I think if we go to the next slide, maybe talk a little bit about that. Roth IRAs are, very appealing for a number of reasons. They grow income tax free like all IRAs, but also distribution. So when they come out on the back end, there's no income tax on that and no required minimum distributions to the original account owner's lifetime, which is nice. But if you want to convert a regular IRA to a Roth, you've got to recognize all that income. Well, you recognize the income based on the value at the time you make the conversion. And so if asset values are down, the amount of tax that's going to be due on that conversion will also be down. And clients may be in lower income tax brackets. They may not have taken their RMDs this year. Their income may be lower this year just because of other sources, business results, whatnot. So it may be a good time to think about doing a Roth IRA. And as I said, maybe marry that with or pair it with a charitable lead trust, because the income that you're recognizing on the Roth conversion can be offset by the income tax deduction on the grantor charitable lead trust. So it's a technique that I really like and think makes a lot of sense. If we go to the next slide, and then really this is sort of the ideas to create, for clients who are thinking about the year end, thinking about doing some planning to take advantage of what may be, a very large exemption that may not be around in the near future. The idea would be to create, what we call a lifetime family trust. I think others call them SLATs, spousal lifetime access trusts. But really the idea is that the client can gift up to $11 million into the trust, allocate GST exemption, so you make it a dynasty trust so it can go on for multiple generations. But the spouse is included as a discretionary beneficiary entitled to distributions for support, health, education, maintenance, those kinds of things. But it's a good way to give away the asset by including the spouse. That there's a little bit sense of, well, there's access, maybe indirect access. Obviously, there's risk of death and divorce with the spouse, but there are some opportunities there. And so this is something that a lot of clients, frankly, created in 2012. And for many of those clients, we're just topping those trusts off. But I think there are also clients who are thinking about, let's go ahead and maybe do something this year. If you go to the next slide, just in terms of thinking about doing that, a couple pointers. One, the good news is the service issued what are called the clawback regulations that were part of the 2017 Tax Act. They finalized those regulations last year, and they essentially confirmed that if you gift away $11 million this year and the estate tax exemption drops to $3.5 million next year, they can't claw back that prior gift, and so you're protected in doing that, and that's good news. A couple pointers. One is if you're making a gift into a lifetime family trust, spousal access trust, and the spouse has a beneficial interest, you need to be careful about making a split gift, because the split gift election really can't be made where the spouse who has the beneficial interest has an interest that's ascertainable or more than insignificant. And the danger is that if a client says, well, I'm going to put 23.16 million into the trust and I'll have my spouse split the gift, the concern is that the spouse may not be able to elect the gift, and so now you're paying gift tax on the overage, which is not a good result. The last thing I want to mention is, just given sort of the bottoms-up nature of how you use the gift tax, is you really have to eat it up from the bottom, and so making one $11.5 million gift by one spouse is better than each spouse making two $5.79 million gifts, because if the idea is you want to use up all the exemption, you really want to burn through one spouse's exemption first. So in planning, just kind of think through some of those things. I think that is it. Let's see, do we have any questions? I think we have. Well, we've already kind of run over. Let's see. So I think we will follow up with the folks who've posed questions, and if anybody has other questions, feel free to reach out to Anna and I. Our contact information are in the slides. I think the slides will be emailed to you shortly. And once again, we appreciate your participation and interest. And anyway, thank you all very much.
Thank you, everyone.